beyond pleasure to introduce to you, if needed, one of most inspiring economists of our generation, Joseph Stiglitz, who is a 2001 Nobel laureate in economics and the lead author of the 1995 IPCC report, which also shared the Nobel Peace Prize of 2007. Formerly, he served as chief economist of the World Bank and is a former chairman of the Council of Economic Advisors. Joe always seeks to have an impact on issues linked to economic welfare and sustainability. He could have participated in almost all the workshops of this conference, given his wide range of contributions on inequality, on carbon pricing, on ways to measure economic growth, on how to finance green infrastructures, just to name a few. And Joe has been a pioneer in all these topics. Regarding mobilizing the financial sector on climate change, he hosted a conference dedicated to the theme 10 years ago at Columbia University. And the topic was much less popular then than it is now. So it's remarkable how things have changed. Joe, the floor is yours.
Well, thank you. And it's a real pleasure to be able to share some of my thoughts. What I thought I would do is focus in particular on some, from a perspective of the perspective of an economic theorist. I thought that was perhaps the most important contribution that I could make. And I had a PowerPoint and it seems to have disappeared. So I will go ahead without the PowerPoint and just talk directly. What I wanted to emphasize is the key role of the financial sector in allocating capital. But the problem in the allocation of capital is that social returns often differ from private returns. For instance, there's systemic risk giving rise to what are called macroeconomic externalities, rise to recessions and bailouts. Another example is the social benefits of lending to SMEs and marginalized groups is much greater than the private benefit. And that's why in the United States and many other central banks have embraced a broader view of their responsibilities, that they need to be concerned about lending to these groups that have not in the past had access, or lending to sectors that have had deficient access to capital. The important point is that one has to use all the tools at one's disposal to achieve society's multiple social objectives. Well, the disparities between the social and private returns are especially large in a world with imperfect and asymmetric information and incomplete risk markets. That was the subject of the research for which I was awarded the Nobel Prize. Those imperfections lead to credit rationing, financial market imperfections, and the implication of that is that in general, market allocations are not efficient. They're not constrained Pareto optimal. There are particularly important allocation failures in the presence of other market failures. And among those other market failures are externalities, both negative and positive. There'll be too much capital allocated to sectors where there are negative externalities and too little where there are positive externalities. And of course, climate change is the quintessential example of an area where there is very large negative externalities. When there are these kinds of market failures, government action is required. And that explains, in fact, the large role that government plays in the financial sector. It plays a number of different roles, and all of these can be seen through the lens of these market failures. I'm going to refer particularly to some of the roles in the connection with climate change. There's a role in lending. Actually, governments are, in most countries, actually have very large lending programs. And that's why there are development banks and green banks. Already in the United States, we've established green banks in New York State, and there is a widespread movement to establish more green development banks in various states, various countries. Having been a chief economist of the World Bank, I can attest to the value, the role, the importance of these kinds of institutions. They have a long-term perspective. Unlike many of the commercial banks, perspective tends to be very short-term. And globally, one of the recently established banks, the New Development Bank, organized by the BRICS, has played a particularly important role in green lending. Then there's the regulatory role, the discouragement of harms that are sometimes done by financial institutions, discrimination, market manipulation, excessive risk-taking, like that associated with the 2008 crisis. And while it's discouraged, regulations can help discourage harms, they can encourage good things. An example is Community Reinvestment Act, CRA lending, trying to encourage lending to underserved groups, or SME lending, trying to encourage lending to small and medium-sized enterprises. Because assessing the full risk of, say, carbon lending may be difficult, it may be best to prescribe certain types of lending. For instance, for fossil fuel development, at least for government-insured banks. And of course, doing so is not only consistent with prudential behavior, but it's also consistent with broader societal goals. There's some further roles of government in providing insurance. Most governments today provide deposit insurance. And in providing deposit insurance, one has to set differential rates according to risk. And one aspect of setting those differential risks has to be climate risk, which I'll come to in a few minutes. And finally, a very important role is disclosure. Markets can't function well without good information, but market incentives to disclose relevant information is far from perfect, far from adequate. We need disclosure requirements to ensure information is provided on a comparable basis. And here, what's important is both disclosure of the physical risk, sometimes called damage risk, and the transition risk, the risk of changes in prices going forward. And I'll come to that in a few minutes. I want to emphasize we need to have that kind of disclosure both for across the board, and that means publicly listed companies, but also for banks. And in that disclosure, it has to be disclosure of the loan portfolio, the risk of the loan portfolio of the banks. And that means if banks are going to lend, the corporations to whom they lend have to disclose their risks. And it's through that mechanism that we can get much broader disclosure within our society. The market failures in climate change are particularly consequential. Obviously, it's an existential issue today. But from an economic point of view, something which is scarce is treated as free or now nearly free good. And that, not surprisingly, results in excessive emissions, insufficient innovation, and it imposes excessive risk on society. One of my concerns, and I'll come to that more extensively, is that the appropriately calculated social cost of carbon, sometimes called SEC, used very widely in the United States for policy and in some other countries, is markedly higher than the prices imposed almost everywhere. Relatedly, the prices currently being used, the price in Europe, the price, the social cost of carbon in the United States will not achieve the climate goals on which the international community has agreed, the 1.5 to 2 degrees centigrade. What we need then is a much higher price of carbon. One of the first executive orders of the Biden administration concerned revisiting the social cost of carbon that have been used under earlier administrations. And in the interim, they've did revise the price substantially upward. But the problem is, it's not enough. It would result, if that price were the basis of actions taken by the private and public sector, it would result in an increase in temperature of 3.5 to 4 degrees centigrade. That has profound implications because it suggests a kind of incoherence in policy, a lack of policy credibility, and that in turn has some important implications to which I'll turn in a minute. What was the explanation of their using such a wrong price in carbon, social cost of carbon, too low of a price? Well, it was based on badly flawed, highly aggregated benefit cost, what are called integrated assessment models, as opposed to those models, integrated assessment models based on how to achieve the globally accepted goals of 1.5 to 2 degrees. A whole set of problems. The damage functions don't reflect adequately the full range of damages, the nonlinearities, the tipping points. Most importantly, they don't reflect the huge risks associated with climate change. They don't reflect adequately either intra-generational or intergenerational welfare. In particular, future generations' well-being is discounted at an ethically unacceptable way. They don't reflect either the full range of market failures. They don't adequately integrate the financial system, of course, the subject of the discussions here. So it was the basis of that flawed model, which had disproportionate influence in the United States, particularly, that the lower prices of social cost of carbon were adopted. And that in turn means the policies that will be adopted will not come nowhere near meeting the goals of 1.5 to 2 degrees centigrade. Prices are important for guiding resource allocations, but I want to emphasize that achieving climate goals requires a much more comprehensive agenda. One needs higher prices to achieve the target of net neutrality carbon neutrality by 2050, but one also needs high levels of public investments and strong regulations. These can be efficient, easy to implement. In fact, it's sometimes easier to have good regulations, such as no fossil fuel electric generating plants, no fossil fuel oil-based cars. Much easier to do that than actually having a pricing system. So one needs a comprehensive package of policies, and the level of prices that one needs to have to succeed in the 1.5 to 2 degrees goal, obviously sensitive to the level of public investments and the nature of the regulations. That's important because the overall package has to be sensitive to intra and intergenerational impacts and risks. And a properly designed package can be much more sensitive to these intra and intergenerational impacts, distributive impacts, and respond more effectively to the overwhelming risks associated with climate change. I want to emphasize not only that does there have to be a comprehensive package, there has to be policy credibility. The reason for this is very simple. Expectations shape investment decisions. The investment decisions that are going to affect emissions in 2050 are being made today. So one has to convince investors that there is consistent, credible policies on climate that will be maintained for the future. Policy credibility, thus, is key to shaping expectations. Unfortunately, the current policy frameworks may not suffice. They may actually undermine credibility. I already mentioned one aspect of this, the excessively low social cost of carbon. Another one is that we have insufficiently comprehensive policies. We aren't doing enough public investments, including in R&D. And so far, there are inadequate risk assessments, inadequate disclosures of the relevant risks. The United States, the Securities and Exchange Commission, appear to be going forward in requiring more disclosures. And that obviously is very important for the financial sector's resource allocations of capital. The point is that if policies are not credible, they won't trigger the reallocation of capital that sets the system towards a new equilibrium that is consistent with climate change. Well, the climate mitigation scenarios developed by the financial authorities and the NGFS have provided financial actors with future trajectories for low and high carbon activities that help set those expectations. Unfortunately, financial actors' expectations can generate both self-fulfilling and self-defeating equilibrium. And that means there are alternative possible outcomes. It's possible to have disorderly transitions even when there are good premises for an orderly one. Thus, it is key to account for expectations in the scenarios. Now, the outcomes depend on the credibility of economic policies, as I've said, which shape risk perceptions, and financial regulation, which can enhance the likelihood that risk perception is adjusted coherently with economic policies. Finally, I want to emphasize that regulators and central banks have a particularly important role, a role in managing, assessing risks. In an economy with high level of interdependencies, such as our economy, attention has to focus on systemic risks. We saw that in 2008, the failure of one financial institution led to a systemic crisis. In the case of carbon, the risks are even greater. Remember that 2008 crisis originated in one part of the economy, in the real estate sector, in one part of the real estate sector, the subprime. And there was a problem of mispricing of the risks, mispricing of the mortgages in that small part of the global financial system. But here, we're talking about the risks associated with Carbon, fossil fuels, the prices today are out of line with what they will be once reasonable carbon prices are put in place. Those reasonable carbon prices, as I've said, are going to be much higher than current prices. And that means assets, fossil fuel assets, will come down and potentially come down very dramatically and very quickly. And that in turn imposes enormous amounts of transition risks. And those risks are systemic. They lie not only in the fossil fuel companies, but in the companies that lend to the fossil fuels, companies that own shares in the fossil fuels, companies that trade with the fossil fuel companies. It is a much larger systemic risk. And that's one of the reasons why it is imperative that one approach the problem from the perspective of systemic risk. In the case of climate change, there are also not only this transition risk, but there's a high level of physical risks, risk associated with rising sea levels, all the kinds of physical risks, the large damages that have been experienced. In the United States, in some recent years, those have been 1.5% of GDP or more. And obviously, that imposes risk to the insurance industry, risk to many other parts of the economy. The good news is that we do have the tools to assess those risks. They're already available. We engage in climate stress testing, for instance, and those tools will be developed further. I want to emphasize this is well within the purview of the traditional role of central banks in risk assessment and risk management. So this is not changing the role of central banks and regulators. This is just a new task that they have to face if we're going to achieve financial stability. Finally, let me conclude by emphasizing that without the appropriate allocation of capital, we won't be able to achieve our climate goals. We can't get climate-aligned allocation of capital without finance fulfilling its essential roles. But finance won't be able to fulfill its role without appropriate risk assessment in line with the scientific evidence on physical risks, transition risks, and mitigation pathways. As I've emphasized, appropriate risk assessment requires financial regulation to demand disclosure and stress testing, and credible economic policies that set expectations and for low and high carbon assets for the coming decades. And the economic policies that have to be part of that kind of credible economic strategy going forward entail not just carbon taxes, but regulations to stop fossil fuel subsidies, public investments in low carbon infrastructures. Absent all of these, financial markets are likely to impose unacceptable financial, macroeconomic, environmental risks on society. So we face the financial sector and the financial regulators face an enormous challenge. It is a new lens through which we have to see financial stability. If they rise to the challenge, the task of meeting our climate goals will be much more easily met. If they fail, it is almost inevitable that we will fail in achieving our climate goals. Thank you.
Thank you, Joe, for your intervention. It's always very inspiring listening to you. And so a very warm thank you for everything you've done, both in economics and on climate change. So now we have a 15-minute break, followed by our next keynote speaker, Frank Everson. We talked about the NGFS and the role of central bank. Frank is the right person to talk about it. So thank you again, Joe, and look forward to continuing listening to you. Thank you.